Welcome, everyone, to the Friday edition of the Markets and Mortgages podcast. I'm your host, as always, Tyler Crawley, and it is Friday, which means you made it through the week. Well, kind of. You're almost through the work week. I guess depending on, I'm assuming you're listening in the morning, so we're almost through. If you're listening in the afternoon, congratulations, the weekend is here, but it is Friday, and I'm not going to lie, it was kind of a light Thursday. It was one of those days where you had some data, kind of the weekly data that you get every week, jobless claims, and, we got mortgage rate data from Freddie Mac, but nothing really big, nothing getting a lot of attention, which, makes sense. Earlier this week, we got a lot of data on housing. We got new home sales, pending sales. And then today, we got a lot going on today. We got Jerome Powell speaking at Jackson Hole. What's the chair of the Federal Reserve going to say? How's that's going to impact markets? Obviously, monetary policy. What does that mean for rates going forward? And then, well, actually, I'm trying to think. I think Powell is speaking at 7 a.m. So then we get, no, it can't be 7. Is it 7 a.m.? What time is Powell speaking? I don't even know. I should look this up. But then we're also getting the information, the PCE index, which is the Fed's preferred, I almost said favorite. It's actually preferred inflation gauge. So I know we're getting that at 8:30. So I think Powell is speaking at Jackson. But 7 a.m. I mean, is that Western time? Is that whenever? I don't know when he's speaking. I'm not even going to try and look this up because I'll spend 10 minutes trying. Here we go. 10 a.m. Eastern Standard Time. He'll be speaking. That makes more sense. I was like, 7 a.m. I mean, Eastern Time, that means he's going to be speaking at 6. So, yeah, he'll be speaking today. So 10 a.m. later today. I have spent way too much time talking about Jerome, which that's okay because we don't have a ton of kind of data to get into on today's pod, but I do want to get into a big one because this was towards the end of the day. I was kind of just going through all my different sources and I saw this over at CoreLogic and I said, yeah, that makes sense. Makes perfect sense. So do you guys remember the conspiracy? Well, you probably do. It's still out there. And this won't stop it, but there was a conspiracy theory floating around that Wall Street wanted to buy up every single home in America, and they wanted to make us a nation of renters. And this is something that's been floating around. I remember this was floated as an idea that millennials didn't want to buy homes because, a lot of millennials entered the workforce either right before or right after the Great Recession. And so they couldn't afford to buy a home. And so a couple of years go by and all of a sudden they're like, hey, young people aren't buying homes. Maybe they don't want to buy homes. Maybe there's this new kind of generation. You look at all these services out there where you can rent cars and you can, instead of staying in a hotel, you can, Airbnb, and you look at people living in big cities and there's a lot of services that revolve around renting. I mean, usually you're renting a place. If, let's say you're in New York or, like I said, a big city, DC or somewhere, and you're young, you're probably renting and you're using services where you're renting services like a car or anything else. And there was this idea that millennials didn't want to buy things. And then, of course, as they started making more money, as the economy recovered, they started buying homes and cars and moving out of the city. And they literally did nothing different than any other generation, other than maybe it took them longer. Millennials that are my age and a little bit younger, because I'm in that weird kind of, some people would claim I'm a millennial, others would say I'm not. I think the official definition is 1979. I was born in 81. Some say it was 83. So I'm right around that kind of cutoff point. And so people that are my age in their early 40s, late 30s, they started doing all those activities later than, say, our parents did and Generation X. And so it's definitely boomers. And so it gave up this perception that we didn't want to buy stuff, but we did. We just didn't have the money. And then we got the money and we did the same thing every other generation's doing. And so I think this is sort of just every generation they go, oh, they're not like other No, they are. It maybe is just taking them longer. I don't know what's going on, but there was this myth that now younger people, whether that's, young millennials or what's the Gen Z, I don't even know what the age gap for Gen Z is. Are Gen Zs, can they buy homes yet? Or are they looking at, I don't know. We're going to be a nation of renters. And this also, fed into this idea that corporate America wants to buy everything and they're greed and they just want to destroy the wealth, because that's the only way you can build wealth, right? Is you have to destroy the wealth of others, which is completely false. That's the stupid idea behind, socialism, which is there's only a certain amount of wealth, and therefore the only way everyone can get it is if you redistribute it, which in reality, as we all know, the way capitalism works is that you become more productive and you create wealth, and then you have new wealth, and then new wealth and new wealth and new wealth. And that moves its way through I almost said trickle down. You can't say that, trickle down economics. It's like a trigger word for some people. You can't say trickle down economics, but that's the way it actually works. At least that's what I believe. And so there was this conspiracy theory that Wall Street wanted to buy all of these homes and wanted to make everyone a renter. And I do want to point out that there are plenty of ways that you can build wealth without buying a home. Sure. Is that the number one way? Is that the way most people do it? Is that a great way to do it? Yeah, 100%. But it's not the only way. I think, doesn't Elon Musk doesn't own any homes. And he's doing okay. He seems to be somewhat wealthy. Yeah, but think about how much wealthier he would be if he owned real estate. he'd really be the richest man in the world. He wouldn't just be the richest man in the world. He'd be far surpassed everyone else with his extensive real estate portfolio. Okay, so why am I talking about this? Well, a new report out from CoreLogic looks at investment homes, or I should say investors buying single-family homes. And surprise, surprise, in the second quarter of this year, investments plummeted in the single-family home market. Investor activity in the single-family market fell 20% in the second quarter of 2022. That is an 8 percentage point drop from the 28% or the 28% high reported in March. Okay, hold on. Let's bring that back for a second. Has fallen to 20%. It actually fell 30%. I'm getting confused here with all my percentages. So it fell to 20%. So 20% of single family home purchases were by investors of all types. That's Wall Street, that's small investors. I think there's small, medium, large, and then mega. And that's mega, not MAGA. Mega investors, like gigantic. That's like the Blackstones of the world. So it fell to 20% from 28% in March. And that was a 30% drop. Investors set a monthly record actually in June, not of 2022, but in 2021 with 147,000 purchases. This level dropped 37% to 92,000 purchases in June of 2022. So investors are pulling back. Now it's still high. While sales for investors have fallen dramatically, the levels are still elevated from a historical perspective. June share is still high and would be more in line with 2019 and 2020 peak activity, which usually happens in January. And as I mentioned, there's different levels of investors. And so of that 20%, so this is of the 20%, 48%, so nearly half, are small investors. That's people who own less than 10 properties. That's somebody who, owns a home, they got some extra money, and they're like, you know what, let's buy an investment property. A lot of people do that. Great way to build wealth. No doubt about it. And it is the most common type of real estate investor. The majority of single-family homes are owned by small investors. They make up 48% of nearly all inventory purchases at the end of Q2. And if you look at the actual data, I think there might even be higher than that. I think it's maybe 60 or 70% are small-time investors. Then you have medium investors. I think that's under 100, which is between 10 and 100 or something like that. They saw a big 4% drop. That was the biggest drop of them all. They still made up 28% of all purchases, followed by mega investors. These are the big guys, the Blackstones, the Zillows, big time guys. They made up 14% of all purchases. And then large investors, I think they're between 1,000 and something. I don't know. I probably should have that in front of me. But you got small investors and then you got, giant ones. Large investors, they accounted for 9% of all purchases. And what's funny is if you look at like the actual data, like Wall Street, even though they did start buying up homes. I mean, of course they did. And even at that point, I think if you looked at all the numbers, they still, big investors, mega investors, I think they own like 2% of all. So it was, they would need to be buying like 100% of homes every single quarter for a couple decades in order for them to be able to get to a point where they would own all the homes and make everyone a renter. So the big question is this surge over? This push for big investors and mega investors? We're seeing big, even medium investors, we're seeing big drops. Well, Thomas Malone, economist over at CoreLogic, writes that, quote, investors are likely more sensitive to the recent interest rate increases than homeowners. For homeowners, the decision to buy is often a lifestyle choice, but investors may be considering single-family homes as an alternative to another potential asset. Therefore, rate increases could cause homeowners to look for maybe less expensive alternatives, such as a smaller home or property in a more affordable neighborhood. But the same dynamic may persuade investors to pursue investment options outside of real estate. I mean, yeah, sure. I mean, it's more bottom line. I mean, if you're living in a home and you love that home and prices go up, rates go up, yeah, you might be more likely to say, I'll bite the bullet, I'll find somewhere to cut. But when you're bottom lining it, I mean, when you're someone who is purely an investor and you're not going to be at that home every day, and all of a sudden it doesn't make sense anymore from a bottom line perspective, a balance sheet, no, then you're gone. You're walking away. And so I know we're thinking, well, Tyler, these big investors, they're not borrowing money at, a mortgage bank or a lender, whoever you're using. Yeah, that's true. But I mean, remember, rates are going up for everyone. I mean, the Fed funds rate is how much, banks borrow from the Fed. And of course, investors borrow money from banks. And so as the bank lending rate goes up, what banks are charging investors, that goes up as well. So all of a sudden, maybe it doesn't make as much sense with home prices reaching a level that they're at. People wondering, are we going to see a correction in prices? Investors are going to walk away. I mean, this is just the way it works. I mean, one of the reasons why investors were flocking to real estate is, I mean, good luck. Over the last year, the stock market has been, the last 8 months, because I think at the end of last year, the stock market was reaching all-time highs. It's been a volatile year. I mean, the market is down. I mean, at one point we were in a bear market. We're, back up above that, but it's a down year. Real estate is not down. Real estate is up. You look at a home. If you bought a home at the end of last year, you're probably up 5-10%, if not more. And investors were looking at these 20% year over year increases in real estate, and they're like, that is a good place to park your money. I mean, real estate's always looked at as a safe investment. It's not a high yielding investment. Then all of a sudden it was making a ton of money. And you're hearing about rent skyrocketing. It just made sense. But the calculation has changed. Borrowing rates have gone up. Home prices have gone up. And we're starting to see a slowdown, not only in home prices, but in rents. And all of a sudden, for some investors, it doesn't make sense. I mean, it's a cycle, the business cycle. That is how it works. And here's what's funny is, so I was reading about this and writing my post over at the website, marketsandmortgages.com, by the way. And I'm not even kidding, like right on cue, it gets reported. This was a tweet from George Perks. Blackstone single-family landlord halts purchases in 38 cities. I mean, it was like on cue. I mean, here I am writing about, this myth of, these investors buying up all these homes, and, the minute it stops making sense financially, they're going to stop buying. And it looks like we're getting to that point. And then it's like literally within 20 minutes of me finishing this post, this tweet came out. And I think it was probably first, because usually when I see these tweets in all caps, it's because somebody copied it from a Bloomberg terminal. So Bloomberg must have been on this. But that's where I first saw it, was George Perks. And it was like on cue. It was like, here you go. Here is where we're going to see the big time investors. Wall Street's realizing that the money's not there anymore. We're hearing predictions of stagnant home price increases and rents possible. Especially if we go into recession, you could see a stagnation with rents as well. And so all of a sudden it's like, well, never mind. Doesn't make any sense. We're going to reallocate our investments. And that's how quickly it happens. I mean, that is how quickly it happens. And it was just so funny because it was, and by the way, that was Blackstone, not BlackRock, who I think most people attribute to Wall Street buying all the homes. There's a misnomer there. I remember BlackRock had to send out a press release like, no, we're not doing that. That's actually Blackstone. All right. I went kind of long on that story, so I don't want to go too long on this podcast. So real quick here, this is kind of good. This is some good news here. Jobless claims data for the second week in a row beat expectations, even though the prior week was revised downward. I mean, you would think that, it's revised downward. Now you're definitely not going to hit the mark, but they did. Seasonally adjusted initial claims were 243,000 for the week ending August the 20th. That was a 2,000 claim decrease, and that was off of the previous week's downwardly revised level of 245,000. Economists had projected that claims would increase to 253,000. So that was 10,000 claim miss. The reason for the drop, I should say, New Jersey, good for them. 1,500 fewer claims, California 1,300, and Indiana just over 1,200. And then for some reason, Massachusetts saw 3,700 new claims. I don't know what's going on up there. Connecticut was up 1,500 and New York was up 442. And then continuing claims also saw a dip to a seasonally adjusted rate of 1.415 million. That was actually a decrease of 19,000. So that also beat expectations by a pretty big margin. Economists thought it was going to jump up to 1.44 million. So pretty good job data. A lot of people were, paying attention to labor markets as we see things slow down, and initial claims had been rising for a couple of weeks. And now the second week in a row, we saw that data drop. And then before we go, this is markets and mortgages. So let's talk about the latest mortgage rates. This is from Freddie Mac, their weekly survey, which of course is not a quote. This is not where, I'm not saying this is where the rate is. If you were to call me, this is what Freddie Mac is saying. This is where they have their mortgage rates. And so it really, what's great about this report is it gives you an idea of which way rates are moving. It just sort of lets you know, are rates moving up or are they moving down? Are they seeing big jumps, small jumps, whatever it may be? So the Freddie Mac weekly survey, they had rates, the 30-year fixed at 5.55%. This is up 42 basis points. That's a big jump. That is a big jump in any, I don't care what the rate is. That is a big jump. The rate is now up 268 basis points from 1 year ago. But here's what's interesting. We've seen some fluctuations between the 30 and the 15 in even the ARM rate, is that there's, in some cases, the 30's jumped, 15's fallen, or vice versa. In this case, a big jump with the 15 as well. Jumped 30 basis points to 4.85%, and they're now up 268 basis points from 1 year ago. And then mortgage rates, in case you were interested, this is a big jump. They have not been this high since June 30th. And they're still technically below the high that we saw on June 23rd when it hit 5.81%. And everyone thought that 6% was right around the corner. And then we saw a couple weeks in a row, big drops. And now we're moving back up. And I have a feeling that the 6% conversation is going to start once again. Good way to end as we go into the weekend. But it's a big day here on Friday. As I mentioned at the start of the pod, we got Jerome Powell speaking at Jackson Hole. And then we got the inflation data from PCE. We got the Fed's preferred inflation gauge, that out. So we'll be talking about that on Monday's podcast. You guys have a great Friday, an even better weekend. And we'll see you here Monday morning for another edition of Markets and Mortgages. And remember, as always, do not wait to buy real estate. You buy real estate and wait.